Hello everyone, and in this part we're going to continue our discussion about financial accounting and how it's related to business. So this is where we stopped at, which is the characteristics of financial information. So as it says here, to be useful, financial reports must possess two important characteristics. One of them is it has to be relevant, and the other one it has to have some kind of faithful representation. So what we mean by relevant? Relevant information has the potential to impact decision making. In other words, it's related to what we are trying to understand and how we are going to make the decision. Faithful representation means that it has to be honest. So the information accurately reflects an entity's economic activity or condition. Now let's talk about the assumptions that are there for financial accounting. So financial accounting and GAAP are based upon the following assumptions. We have four assumptions that we need to learn. We have the monetary unit, time period, business entity, and going concern. So let's start with the monetary unit assumption. Monetary unit assumption, in simple words, is that everything in accounting is measured in money terms. So everything in the United States, whenever we have a business, we translate everything based on dollars. So the monetary unit assumptions require that financial reports be expressed in a single money unit or currency. So we cannot really mix different currencies within the same financial statement or financial report. So this provides a common measurement of the effect of economic events and transactions on an entity. The monetary units used is normally determined by the country in which the company operates. So if we're in Europe, we're going to use something like the euro dollar. If we're in Japan, we're going to use like the yen. If we're in Mexico, we're going to use something like the pesos. So this is like the current currency of the country where we typically present the financial reports. The other assumption is the time period assumption. And the time period assumption allows a company to report its economic activities on a regular basis for a specific period of time. So this is like an artificial period. If you think about any business, a business starts with an intention to stay for a long time. However, we try to break it down into periods so we can understand how the company is performing. So if you have a business that you want to measure its performance, we typically wait maybe until the end of the year, like December 31st, and we try to combine all the transactions and see how the company performed. Some companies decide to do this on a quarterly basis, every 3 months or every 6 months, which we call it semi-annual. But most companies, they wait for the end of the year to measure how they perform. End of the year doesn't have to be December 31st. So fiscal year could end on any day of the year, and we'll see that in the future. So in doing so, financial condition and changes in financial condition are reported periodically on a consistent basis. The next assumption is the business entity assumption. And this assumption limits the economic data in financial reports to that directly related to the activities of the business. In other words, we are only relating the transactions that are relevant to the business in its financial reports. Like what about transactions related to the business owners, like personal transactions? These cannot be combined with the business entity transactions. So we have to have a separate kind of record and economic data to be presented in the financial reports that are only relevant and related to the business. So in simple words, the business is viewed as an entity separate from its owners, creditors, or other businesses. So let's see here the different forms of business entities. And I think maybe you cover that in other business classes, or maybe you'll cover it in the future, but I really want you to know that businesses are typically classified into three main categories, which are proprietorship, partnerships, and corporations. We're going to add to that the limited liability company, which is another form of a partnership. So a proprietorship is a business that's owned by one individual. And you can see here in the United States, it's about 70% of business entities. Most businesses, like 70% of businesses, are one-owner businesses. Why it's very common? Because it's easy and inexpensive to organize. The resources are limited to those of the owner, and it's used by small businesses. So most small businesses are structured as sole proprietorship. On the other side, we have partnerships, and this is owned by 2 or more individuals. And this is about 10% of business organizations in the United States. We are combining that, of course, with limited liability companies, which are shortly known as LLCs. What's the good thing about partnership is that you are combining the skills and resources of more than one person. So we have like partners working together. The problem with proprietorships and partnerships is that it's a little bit risky, because if anything goes wrong in the business, your personal asset as an owner is not protected. So to try to solve these problems, the businesses are allowed to be structured as limited liability company. And in this case, you're going to have very limited risk if your company is structured as an LLC. So an LLC combines the attributes of a partnership and a corporation. So it's often used as an alternative to a partnership, and it also has a tax and a legal liability advantage for owners. If I go back to corporations, this is organized under state or federal statutes as a separate legal taxable entity, and most large organizations are structured as a corporation. They generate 90% of business revenues, because these are large companies, and don't be surprised to know that all of publicly traded companies are structured as corporations. However, 20% of business organizations in the United States are only structured as corporations. So all the companies that we know, like Apple, Google, Ford, and you name it, these are corporations that are traded in the stock market. So as I said earlier, this is used by large businesses, and they can obtain large amount of resources by issuing their own stock in the stock market. Then the last assumption that we need to know is what we call the going concern assumption. And the going concern assumption requires that financial reports be prepared assuming that the entity would continue operating in the future. So a business or an organization is not structured like a project that has a starting date and an ending date. We always assume that a business is going to continue as long as the business can survive. So that's what we call the going concern assumption. Now let's talk about principles. And again, we have another 4 principles that I want you to understand. They're very logical, easy to understand. Maybe some of them would be new to us, but they're very, very logical to comprehend. So what are these principles? We have the measurement principle, historical cost principle, revenue recognition, and expense recognition. Let's start with the measurement principle. And here it says the measurement principle determines that the amount that will be recorded and reported. So this is that's the main idea about the measurement principle, is that it determines how much we're going to record and report. So the measurement principle requires that amount be objective and verifiable. An amount is objective if it's based upon independent, unbiased evidence. An amount is verifiable if it can be confirmed by a third party. So transactions between 2 independent parties called arm's length transactions provide amounts that are objective and verifiable. So in simple words, by measurement we mean that, or the measurement principle, we mean that we can measure the value of the transaction objectively. And the most common way to make sure that this is an objective way is to see how much I paid to acquire a product and how much the other party accepted to receive as a payment or compensation for that product. It could be a product or service. The second principle is the historical cost principle. And again, this is also another way of objectively measuring a transaction, is to rely on how much we actually paid to get a product or service. So let's say I acquired a pen and I paid $1 for that pen. And then over time, this pen appreciated in value, so it went up in value. It went up to like $2. Based on accounting and based on the historical cost principle, everything should be recorded based on its original cost. We cannot keep changing it based on the market value. However, there are a few exceptions, and we'll talk about these exceptions in the future. So recording an item at its initial transaction price is called the historical cost principle, and sometimes we call it the cost principle. Then we have the revenue recognition principle. And what is revenue? Revenue is the amount earned for selling goods or services to customers. So anything that you earn. It doesn't have to be in cash, and we'll get into that. But revenue is any kind of amount you earn from selling a good or providing a service for a customer. So the revenue recognition principle determines when revenue is recorded in the accounting records. And for it to be recorded, it has to be realized. Okay, so normally revenue is recorded when the service has been performed or goods are delivered to the customer. So what if a customer pays us in advance for a product that we're going to deliver to them a month from today? Is that a revenue? No, it's not a revenue, because it's not going to be a realized revenue or a recognized revenue unless we actually provide the product to the customer. Same thing for a service. If they pay us in advance, then it's not going to be recognized until we actually provide the service. Let's look at it from the other way around. What if the customer, we provide them the service and we bill them, but they haven't paid us yet? Is that a recognized revenue? Yes. So once we provide the service, whether we receive the cash or not, it doesn't matter. It's a recognized revenue. So once we provide the service, once we deliver the product to a customer, this is where the revenue is going to be recognized. And that's the revenue recognition principle. The other side of the coin is the expense recognition principle. Sometimes we call it the matching principle. So what is an expense? An expense is an amount used to generate revenues. So the expense recognition principle, sometimes called the matching principles, requires expenses to be recorded in the same period as the related revenue. So we have to match revenues and expenses at the same period. So doing so allows the reporting of a profit or loss for the period. So I want you to remember, we always tie revenues and expenses to the service of the product, whether it's provided or received, not to cash. Okay, because cash is something that can be paid before the service or after the service. And of course, in many cases, it's also done simultaneously while receiving or providing the service. Let me stop at this point, and in the next video, I'll start talking about the accounting equation.